Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Jeff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we put out into the investing universe. The best way to do that is to follow me on X at Focus Compound. Go to focuscompound.com to get access to investment write-ups from Jeff going all the way back to 2005. And of course, if you're interested in our money management services, you can reach out to me at andrew@focuscompounding.com. So today is August 14th. Just
We're recording, yeah.
when we're
hmm
another day.
Yeah.
What are you,
Just
50? Are you 50 years old today?
yeah, 50. Yeah.
50.
Yeah.
40 or
No,
41?
I'm 40 years old today.
40 years old. That's right.
hmm
Congratulations. We made it.
hmm
Um, I'm 29, which I can't believe. We
hmm
met when I was like, what, 20, Been
Yeah.
doing this for a while
hmm
together.
Yep.
Yeah. So happy birthday to our fearless leader, Jeff Gannon. 40 years old, new decade. Very exciting. Very exciting. Now we both live in Florida. We don't even live in Dallas. Lots
That's
changed.
true. Yep.
A
hmm
lot has changed. Anyway, so in today's podcast, Jeff, we are going to have a question and answer session. So I tweeted out, of course, on X, a tweet to pull some questions from people, and people had sent in some questions. I like to do these every couple of months. It's been a bit since we last did this, and then spend some time answering them, right? And get through as many as we can. So if you're watching on the screen right now, first question: what industries would you recommend I research to find another stock with similar characteristics as my favorite bank? He's talking about Truxton. Double-digit growth, 2 to 4% dividend yield, plus profitable every single year. Low beta.
Yeah. So there aren't a lot of industries like that. Banking and insurance, the leaders in it, have numbers that look like that. 2 to 4% dividend yield is hard. I mean, I guess Buffett owns American Express, a company like that. It's not doing double digit growth at this size, but it has similar things to that. Otherwise, outside of financial stuff, it's consumer staples type stuff, but most of those are too mature at this point, so they don't grow that fast. Yeah, there's a fund manager, Terry Smith. Most things that he owns are kind of in that kind of category. They sometimes get expensive, so they don't have that dividend yield. But yeah, I'd look at like everything he owns probably.
And that's Fundsmith, is that correct?
Yeah, and historically, the things that Buffett would own, but I think that's tough today. Like I said, American Express, when he bought it in 60 years ago or whatever, probably looked a lot like the numbers that you're saying actually.
Mm-hmm. I have his 13F, which
Okay.
I don't believe is as recent. So most funds they have to file by end of day tomorrow. So some are trickling in
Okay.
early this week. But you got like Meta, Microsoft, was that Stryker, SYK,
Yeah.
I think.
hmm Yeah.
Philip
He owns some. Yeah,
Morris.
I didn't mention healthcare. He owns a bunch of so not healthcare directly, but like instruments. Waters is like consumables, things like that, lab equipment type stuff. If you look, even though it says healthcare, it's not just general healthcare stuff in there. It's a little different. Yeah. Nike. Okay. So, Nike gets expensive, but it's probably had periods where it wasn't far from that. It hasn't done that well in the last 10 years or something, but probably when Lou Simpson owned it, it had numbers like that. So, yeah, look at revenue growth now is 4%. And obviously, dividend yield on these things is not great. They're a lot more expensive. Yeah. Banks are probably the best place to look for it right now. I mean, when I wrote up Progressive, it probably was pretty close to that, but it's gone up a lot in price since then. So, it doesn't look like that anymore. You don't have that kind of dividend yield or anything like that.
Mm-hmm, mm-hmm. Somebody actually also asked us about Progressive, which we could jump to. Let's see if I could find it. Any
Oh,
thoughts
someone
on
under that said
Progressive?
OTC markets, and that's correct. OTC markets meets those criteria basically. Uh, it, It doesn't. You could look it up. A dividend yield would be the part that might be interesting. It's a little bit cheaper now than it was in the past, but that would, over a longer period of time, fit the requirements.
For OTCM, dividend yield 4%.
Yeah. So in recent years, this year it's like single digit revenue growth. The last couple of years were low single digits, if that. But if you go back any 5-year rolling period or something, it's probably close to that. So OTC markets is probably the closest to Truxton, which you mentioned there, is what he's probably talking about in terms of meeting those criteria.
Low beta.
Right? Because he said double digit. Oh, yeah, low beta. I mean, yeah, it should have low beta, yeah.
Yeah, 0.47 is what QuickFS says. Share turnover low, obviously. Ran by founder. They do buy back stock, but that just offsets dilution.
Yeah, one huge thing with those is we just said 2 companies that are in financial services in some sense. OTC Markets isn't like in the business of actually providing, it's a financial information services. They're both over the counter and neither files with the SEC. And technically, I don't know what people call microcap now, but if you're $500 million or something is still a microcap or whatever, then I guess they're also small stocks. So they're small over the counter and don't file with the SEC, right? OTC Markets doesn't because it's putting it on its own markets intentionally to do that. And then also banks, especially banks that aren't holding companies, can do other things to file with the regulator and list and stuff. So you could pull FDIC reports and things, but they don't have to be SEC filing if they don't want to be. And I believe that's the case with both of these companies. Mm-hmm. So maybe a little less likely that it would pull data for it and whatever. I don't know. But I mean, if you put it in a Bloomberg, it'll find it because OTC Markets, one of their biggest customers is Bloomberg. So I'm sure that all that stuff comes up on Bloomberg. Yeah.
Mm-hmm. Mm-hmm. Specific to OTCM, the person asked updates with the introduction of OTC ID.
Yeah. So, I mean, this has been their practice for a long time, right? So people in our, it's clear they've been planning this for years now, and it annoys some fund managers and other people like it or whatever. But it's clearly been an effort to separate out the difference between dark, not telling you anything, whatever type stocks, and a higher and in the long run, more expensive, more making money for them level of stocks with information provided by it. So kind of cutting up the pink sheet so that it actually has they would say the market will be more efficient, it'll be more transparent and all that, but also they'll have more things they can charge for and make money off of. So kind of there used to be a lot more stocks in a middle zone there. I mean, the pink sheets before they had changes to rules with the expert market and everything. So some of this is OTC Markets technically, and some of it's regulators, but OTC is one of the ones that they pay the most attention to what they're asking for in comments and stuff. So I don't know how much of a difference it makes. But basically, there used to be a wide variety of pink sheet companies that did everything from not telling you anything about it. I mean, there's some that you had to ask them to give you reports and things, and then they would, to they sent out reports and everything, but didn't timely put them up on their website or whatever. So shareholders were getting it, but it wasn't going out there. To companies that were putting things out on pink sheets just like they were, any other public company. It just wasn't. You didn't know the quality of what they were doing. They were almost complying with rules and regulations themselves without needing to, and then saving money that way. And now that's going to change. So it's going to shrink. It has been already shrinking kind of the overall investable market for people, but in theory, making all these companies closer to the other tiers of OTC markets and just to what you expect from stocks generally. So like a lot of things have been having the public markets is making it more expensive for companies that are public. It's shrinking the number of public companies, and it's improving the disclosures and increasing the rules and things for companies that are public. So the gap between what an OTC stock is and all sorts of other companies is smaller, but it also is causing probably some cheap companies, some good companies, to kind of disappear from the public markets and stuff because they don't want to comply with these things. And a lot of it is just probably exacerbating the kind of risk of kind of agency type stuff, like in terms of this the ones that want to stay on and provide the information and pay and everything are probably more owner oriented, and the ones that don't are probably ones that the insiders are happy to not share that information and stuff, and they don't care if the stock goes down. It's not as bad as like AIM in the UK. They've had even worse problems. I mean, there's tons of companies that get because of how that works, they've squeezed out people and gotten terrible prices and things when a company leaves AIM. So,
and there are businesses that really, to your point, never communicated, but now they'll put up like an annual report, their version of it, right? It's not like an SEC type thing, but it's like audited financials is what they'll put up.
Yeah, because obviously all these companies would have had audited financials anyway, generally, and a lot of them were putting things out to shareholders and everything, and this will help with that. It's not hard to do the things you're talking about today versus 20 years ago in terms of having a website or putting that stuff up, and then they can see what others do. But the answer is they want, a lot more things they can charge for over time, and to encourage smaller companies that were pretty dark to behave more like other companies, and then to pay OTC markets and other type providers in that ecosystem more money over time. So, I think that's their purpose for doing it. They want to make more revenue over time for it and everything. And other things equal, they probably prefer to operate a more respectable set of businesses that are paying them money than not. But any exchange and stuff will probably take either one if it makes them enough money. But they probably prefer that they be filled up with businesses that are trying to do the things that they claim about, trying to have efficient markets and good information and everything.
Do you have any thoughts on OTCM at these levels? We first started talking about this company on the podcast. I feel like it's always kind of traded at a similar PE. But we're at 23 times PE, EV to free cash flow 16 times. Obviously, it's a very high quality, I think it's capital light biz.
Super cheap compared to so you're saying that the PE is similar, and that's true. But compared to Mag 7 type stocks and things, they used to be priced similarly, and now it's so much cheaper because yes, the PEs on them look similar, but remember that this company doesn't reinvest in the EV to free cash flow of other things has gone skyrocketing, because although their earnings are the same, they're now reinvesting a lot in other stuff. OTC Markets is a tech oriented company this way, right? In terms of information technology stuff, that's what they do. That all their spending is still through the income statement. They don't reinvest in stuff. You can see their free cash flow. They even get paid up front on things. So it looks completely different than, Facebook, Alphabet, Amazon, whatever, that used to look like this and don't anymore. It's more like FICO in those. So yes, the PE might look like that, but actually on a free cash flow basis and growth in free cash flow, it's really, really, really cheap. I think in general, I don't know exactly how the stock does over time with looking at the past and what's happened. My suggestion is to always look at it at times where the revenue growth has been slower for a little while, because, and this is similar to, I actually suggest the same thing for FICO, to be honest. If the company has some pricing power and gets things from a lot of different fees, listing things and whatever stuff, they don't put through changes to the market like this, like OTC ID, or price increases that are major every year. They don't care about that. So they may increase prices by a lot and have a big up year, and then not do it for a few years. So if you have not a lot of growth, and in fact, recently you've had shrinking in volume, because the market is just less speculative than it was in that 2021, 2020, period that you see where they grew so fast. Unless they put through price increases and change things up that way, you're not going to see revenue growth. But that doesn't mean that they can't choose to increase revenue later. They're mainly capped by what are the fees on NASDAQ and I guess to some extent NYSE. And we'll see if there's eventually a market in Texas or something. That would also be an issue eventually. But you see all their margins have declined a bunch. Gross margin, which we talked about, declined a lot, and even operating margin declined even more than that. So those are all things to keep in mind.
Why did it decline?
I think they've been So I think they've been doing sales types activity on trying to improve certain things and change things with the business going forward, on top of revenue that isn't growing that fast. But I don't think the two are very related. So if you'll look, the margin expanded a lot in like 2020, 2021, because I think when their revenue goes up 10 to 40%, they're not going to increase their expenses anymore, but they're going to reinvest. Like I said, they invest through the income statement. So they're going to keep growing their expenses at a pretty steady pace, no matter what. At some point, maybe they'd be somewhat caring about what investors think and not wanting to post lower earnings. Compared to most companies, I don't think they do care as much. And I think they will like stick to their plans about what they're going to do about that, regardless of whether things go up a lot or not. So their growth in things like earnings per share could be pretty lumpy there. They, from 2019 to 2020, 2022, whatever, it like doubled, and then it's been flat since then. But I think that doesn't change how much they increase expenses probably. So I think that when revenue is growing 10% a year, the margin looks fine. But when it's growing 0% a year almost, it's not quite there, but it's close. I just pointed out because kind of what the question was about. It is profitable every year. It almost every year would have revenue growth. I don't remember the last time revenue didn't grow there. It doesn't necessarily have volume growth though. Some of those years are just because of price growth, like actual volume of listed number of companies, and certainly volume of transactions and number of people using the information for trading purposes and stuff has gone down, especially with non-professional use. That definitely falls off sometimes. So,
Got it. Let's see. Next question. General investing question. If your life depended on it and you had to generate uncorrelated returns that beat the SPX, what strategy would you try?
It depends on beat the SPX like year to year or beat it, long term. The research things and what you would do are the same, which is, high active share, long holding period. I invest in myself and can see what I did on that period before managing other people's money. It had very low correlation to the S&P, even in cases where it was the stocks were mostly in the S&P similar stocks, and sometimes even in the S&P. So if you hold a small number of stocks for a long period of time, the correlation can be super low. We didn't use that stuff, but I researched it before we started raising money and stuff. And to give you an idea, correlation was lower than long short funds. So I know it was 100% long. So correlation happens because you're kind of hugging an index in terms of what you're selecting and stuff, because you would think a long short fund would be trying to be less correlated than that. I was not making any effort not to be correlated. It's just if you have no selection that's based on any way and trying to think of what's in the index, you won't be that correlated.
Somebody asked us about QVC, said debt analysis and their possible options to avoid bankruptcy. I don't know how much we could go into that on the pod, but do you have any just general thoughts on QVC?
No.
Market cap 29 million, EV 4 billion. So dire straits for sure.
So what's the history? Does it say in the background, describe anything? We could go back there because I think, let's see. Yeah. So I did look at the company before because it was formerly known as Curate Retail and changed its name to QVC. QVC is the older name. And it went with that for a few years. So it was a
lot of value investors like this company. I remember in 2020, and I would see this often. You seem like a lot of these companies, like somebody else asked us about SIRI, right? Or even like the Charter, sort of like those companies that are probably like, if you want to think about like the terminal value is like in decline, but how do you make money from point A to that eventual decline? Are they returning capital? Are they doing dividends, like big dividends, special dividends, and you're getting your capital out? What happens in between there? I remember people talking about this company a lot.
Yeah, and to be fair, with some of these, a lot of the capital was taken out. I don't remember the details on all of these, but there's a preferred and recapitalization of the company. Some of the owners, in some cases, may have gotten capital out that isn't reflected in the results. Yeah, so what was that? $1 billion of dividends in a special, and then the next period is 503 million, right?
Yeah.
So now they also bought back stock and they didn't do everything that you could, but it's more an issue for the debt holders than it is for the shareholders. So kind of what you were saying is, I don't know. I mean, is that a bad idea? The equity holders to some extent, I guess, got capital out of it, and the debt holders won't get 100% on for the debt that they had. So maybe
Usually the other way around.
that was a good recapitalization for them. Well, yeah, you're saying that, but let's look. The issue with Sirius and QVC, and some of the others and Charter that you're talking about is, it wouldn't be terminal if it was financed 100% with equity. I mean, what's QVC's situation in terms of what the cash flows had been before, what debt had been or what income had been higher up the income statement? If they had no debt, and there's no reason why they had to have debt, then, I mean, they've never had operating profit that's hundreds of millions of dollars of operating profit, right? It, I mean, they have debt. Like, if this is correct, they have $4 billion of debt. Well, that's a lot of debt. Even 10 years ago, it's saying that their operating profit was only 1 million. I mean, the number that matters because it's complicated because they have their retailer, but then the inventory situation is different because of how they sell. So let's go to the cash flow statement. Yeah. So what really matters is the cash flow from operations, which, as you saw, dropped off a cliff after around COVID times. They had some other issues, though. I don't remember. Do you remember that there was a destruction of something, a fire? There was an issue that happened beyond just declines in sales. Something happened too in the last few years, if is my memory. There was some issue.
I think it was a fire.
Okay. So if you look, you can see that obviously they knew by then that they couldn't buy stock back, right? They haven't bought any stock back after buying a ton back. So they were doing a lot of stuff through 2019. Then you have a couple of years of COVID, that drops off. And then you're obviously thinking you're about to go into bankruptcy for, the last 3-4 years. But cash flow from operations has been nowhere near what it would need to be to handle the debt load that they've had, right? So that's been going on for a long time.
So much debt. Yeah. I don't know. Good luck. I just hate these businesses, honestly. I would never want to own
all
one.
the time?
Yeah, just one. No, I mean, yes, of course, but I just mean where the terminal value again is just, they're in a terminal secular decline.
Okay, but 10 years ago they had the same gross profit they have today. So I'm not 100. I mean, I understand that that's the perception that it's in total decline that way, and of course, in real terms, they're lower. But their operating expenses are up a lot, and their capital structure caused them a lot of problems. I don't know that means you can't have done the same business that they were doing over time and then taken the money that they had and pivoted to other things over time. I just don't believe that if they reinvested in their business in completely separate areas over 10 years and didn't put on any debt and didn't pay any dividends and didn't buy back any stock, that the entity wouldn't survive in some way. Like it's common to have businesses where something about that business is in a big decline, but the corporation still continues to exist because it doesn't stay solely limited on that. Now, my memory is they have major shareholders that are invested in other things too. And this is a diversified position for them that way. So the other ones you mentioned, Sirius and Charter, same thing. There's no reason for them to merge with a bunch of things that way instead of just paying out dividends, buying back stock. This looks to me more, although this is a public company, more like what happens in a private equity controlled situation, which is not necessarily what would have happened if this was a founder or something. I don't know that like this is worse than what the situation that we talked about. What do we talk about? Did we talk about Dillard's? What ones did we talk about? That also would have been like not in a great 10-year trend, but they would have been very careful to, they had just different incentives about keeping the business together and stuff. They were overcapitalized with stuff and didn't take on a lot of debt to do that. And, but their gross profit 10 years ago and today is pretty similar too. So, it's just the Charlie Munger thing where he said that General Motors going into bankruptcy is, that never had to happen because the corporation obviously could have continued to exist and not brought shareholders down to nothing just because their car business in the United States was going to decline slowly over a long period of time. You could have moved from that to other things.
Mm-hmm.
No one is forcing you to stay in exactly the same business doing the same thing. And they're certainly not forcing you to put on a ton of debt onto something that isn't going to grow its ability to manage that debt.
Mm-hmm. That's a great point. Great
And
point. So how do they
SiriusNet
get out
is
of it?
definitely that way too, right? I mean, because if that was totally debt free, I believe people would have, it would be a less volatile stock. People would be less concerned about it, I think.
Mm-hmm. Yeah, I mean, gross
Yeah, because
profit series only improved.
yeah, well, there have only just the last 2 years or so that the trends have been bad. I mean, they actually had good trends a long time ago. We've talked about that their aging is not good in terms of like the average age of their customer has gone up over time. So they've kind of grown with a generation, but not age adjusted for that. So they're still big with like baby boomers and Gen X or whatever. They didn't keep the same kind of age customer. So eventually that would cause problems. But their penetration with that group was good and actually doing pretty well. If you'd grown up listening to radio, they actually did really well over time with you.
Mm-hmm. Let's see. So any thoughts on Progressive with it selling down 10%, trading at about 13 times earnings, low cost operating, and taking market share?
Yeah, we can look at them.
$146 billion market cap. QuickFS has it at 14 times earnings. EV to premiums, 2 times.
Yeah. So my concerns are, yeah, the PE looks fine, but it's on an incredibly high earnings. More important are things like the price to premiums and the price to book. And then the other thing to think about is what the returns look like that you're seeing here. Very, very high on equity, on underwriting, and then also to think about the market and about competitors. My concern is not that the PE isn't justified. It's just that I don't think the earnings will grow a lot from here, just because you're cyclically at a peak in everything. So they're cyclically pretty strong competitively. They're cyclically strong in terms of what they can earn on investment things, on underwriting things, and the market for insurance things is different now than it was a couple of years ago. So, I mean, yeah, they'll have a hard time with their earnings growth in the near future, probably. So that they'll grow into that PE, but it may be that the E has to go up over time and the P has to stay pretty flat, just because you're buying at kind of a top in terms of E. I would look at premiums and book always. I would not look at on PE basis.
Mm-hmm. I mean, what's the buy zone on a price to book? Obviously, the lower the better, but generally speaking, like what's a fair price where it would catch your eye that it is a fair price time to buy in for an insurance company?
Oh, well, for an insurance company, low, like 1.
Yeah.
For Progressive, though, you could totally justify it if it was a different situation here at, 3 times book would not be an issue at all. Now, they are quite leveraged to underwriting, but yeah, something that posts 21% returns on equity, 3 times, they're at 20% or something, but 3 times book, in today's environment is definitely not a problem. It is, though, at 4.5. And like I said, there's leverage there in terms of especially premiums. So if those things change, so I don't know if their like advantages will grow over time or others, will be able to catch up that way. And of course, then there's also thoughts about, in this industry, there's always thoughts about 2 things, which is self-driving cars. Will that shrink the overall market over time? The other thing is AI. If AI was actually good at pricing insurance risk, then does it matter as much differences between companies if they can all just have, invest in having similar AI things that have been developed for other purposes to be able to help them with their insurance things. And I have none of those things are here yet. So,
What are your thoughts on that? AI as a disruptor, or basically turn this into a commodity where they're just going to drive the price down of things?
well, so AI in the sense of the stuff we've seen recently with Chat GPT or whatever is new stuff and has excited people. But in terms of using it for pricing of insurance things, it's old. And I talk a lot with someone who's involved in AI stuff, right? Who that's the academic background. And actually, one of the things that he thought years ago, 5 years ago or more, was most helpful is in alerting insurance companies about unusual patterns due to very high frequency data so that you could see that in the last few weeks, you need to raise rates in Florida because something's going on in Florida and you need to do this now for earlier detection. However, he also felt that over longer periods of time with any lower frequency data, AI was useless. So AI very useful for analyzing. Same thing for companies analyzing buzz by looking at X and then predicting how will a movie open this weekend by analyzing the 10 days leading up to it and feeding in, a million tweets or whatever we call these things now, could predict. But predicting, let's make a movie so 3 years from now it will have buzz. That was where it was. I don't know that it helps at all that way. And setting rates longer term, it might not help. For a car insurance company, it would help. So it would help you detect faster than others and be able to adjust your rates faster. Most in things like car insurance, they renew pretty frequently, and everyone eventually gets there in terms of rates and things. But if you're always 6 months ahead of everybody else, that's an advantage. So, and historically, they were good on that. But there are sometimes shifts, and they don't always know the reason why. So Progressive, for instance, overshifted many years ago. This is going back like when I was looking at 10 years ago, and ended up with much wider margins than they wanted because they priced too high. And I think they priced too high because they saw changes in customer behavior. I'm pretty sure it was changes in customer behavior having to do with smartphones. They were seeing accidents and things that they'd never seen before, deaths, things like that. And it was spiking in terms of patterns that something was happening. And over time, that has kind of proven true. Like since smartphones were introduced, there's no longer, it's no longer safer to drive over time. That's kind of flattened out since the introduction of smartphones, especially with things like pedestrians being hit and stuff. So they're kind of correct in that. But I think that kind of thing spooked them initially because of how quick the deterioration was, and they didn't understand what it was in the data. And so they had wide margins suddenly and not enough growth because they priced their policies too high on that. And so you'll detect things like that. And sometimes with AI stuff, if they're in the future, it could be a bit of a black box where they don't know what it is and they adjust prices to it and they never figure out what it was or whether it was right or whether it was a temporary blip. But then the idea is if you feed it a lot of stuff and do it very quickly, it'll go away. There'll be this blip and then it'll go back down, kind of like market stuff. Why does a prediction market suddenly do this? People write articles thinking that we know what it means, but sometimes it just happens and then it goes back down. I don't know. And that will happen if you kind of rely on that more. But for very short term, being able to be faster on analyzing a lot of cases coming in, and car insurance companies have a ton of claims, it could be helpful. Yeah.
Very interesting. The self-driving car thing hasn't really played out.
No, it's hard to know how that will affect insurance companies. Obviously,
that's been a risk for 10 plus years.
Yeah, like people talk about like global warming stuff. It's not a risk for global warming stuff. Is not a risk for insurance companies' business because as long as you price right, it adjusts slowly over time. If anything, you might be writing more policies. It's I mean, you can adjust to anything. If you wrote insurance against war, and there were a lot of wars, okay. I mean, they don't insure wars, but if they had to, because they could have more policies, things on that. Since the terrorism thing was introduced in the United States, it's never been triggered. The federal government program for that. So you could write on all sorts of things. It's just that go up and have more claims because society changes. It's just the issue is basically if there's no need for the risk anymore that way to be insured. And if it changes the distribution, the idea being like, would car companies need the insurance, right? So over time, would it be that you as a driver don't matter in risk selection? Because it just matters what the car is and what systems it's running. And so, yes, maybe Tesla needs a ton of insurance as a company, either to pass on to you because laws might still require that or something, or just gigantic policies. And then they take those losses. They're self-insured against that kind of stuff. So maybe we will impose insurance things on the manufacturers of the car, not the operators, or on the systems that they're running. And then you will need multi-billion-dollar policies for that. Mm-hmm. Or maybe it will be something that's passed through. We don't know. But if the driver no longer has any importance in the risk, and right now they have huge importance to it, then the policies won't be priced differently depending on the driver. They would just be priced based on what the vehicle is, what it's running, and things like that. And also it change other things because presumably states would have a harder time having differences in legal systems and things between states if everyone knows empirically that the only differences are the vehicles, like, I mean,
Mm-hmm.
why are they paying out so much more in one state than another or whatever? And those wrinkles would kind of go away over time. That's proceeded a lot slower than I thought. So I did the thing on Progressive. I thought it would be a lot slower than most people thought, but I thought it would be a lot faster than it's been. Self-driving cars as actually driving people around and causing accidents instead of people no longer causing accidents has been super, super slow progress on that.
Mm-hmm. Let's see. Good to go back. Ever looked at MSGS, Deep Valley, no callus, but keeps ticking along? It's been about 10 years.
Yeah.
Since I
So
looked
is
at
this the same
Madison Square
stock or was it
Garden.
split out? Yeah.
Remember
Because
they
we already looked
they
at when it's
they were
split
spun
out. Yeah.
out. Yeah.
Okay.
Uh-huh.
So what part is this, if the business description?
Let's see.
Okay.
Operates
Yeah.
as a professional sports company in the United States. The company owns and operates a portfolio of assets that consists of the New York Knickerbockers of the NBA
Mm-hmm.
and the New York Rangers of the NHL.
Yep. They
I wonder
also
how long
have
that pretends. Because
some
they split
small
off
American hockey
Madison.
recently. Yeah.
They split
Yeah.
off Madison Square Garden Networks, right? Is that what it was?
Yeah. So yes, but then that was true when we looked at it. Those two were the two split out. But then I believe there was even a further change since then. But you're right, 10 years ago or something, that's what it was. Yeah.
Is that even public anymore? So Madison Square Garden
Entertainment.
Entertainment Court.
Yep. Mm-hmm.
Got it. Let's see. Okay, we could pull it up on QuickFS. Okay, what was he said? No catalyst, but keeps Deep Valley. No catalyst, but keeps ticking along. EV to sales 4.6 times. Price to book. I mean, this is obviously pretty skewed.
Yeah, I think they probably mean value versus some of the parts if there's a buyer for a professional sports team. Yeah.
Yeah, you take the value of like
yeah.
what people are paying in the industry and what could that be? I mean, Cuban sold that's got to be the last sort of mark to market, right? In the industry was when Mark Cuban sold the Dallas Mavericks to a Las Vegas group.
Yeah. And so who is it that does it every year that people rely on for this stuff? Is it Forbes? I forget which one, but a lot of them use the same list when trying to do the valuation, which does a value for every professional sports team, at least in like NFL and NBA and MLB, which is based on what you said, like the past sales and then what market you're in and things like that. It's gone up tremendously. I'm amazed on especially some of the lesser teams how much it's gone up, the valuations on them. Yeah.
Mm-hmm. So you do with some of the parts on something like this. I mean, is this just sort of, I don't want to call it an orphan stock, but is this like a one-day stock that you could own in a portfolio? And, if the animal spirits perk up in the industry, I mean, obviously valuations of sports franchises has gone up over time, like tremendously over the past 20 years.
Yeah, I mean, I wouldn't be involved just because I don't want to be involved in sports franchises, given that I can't find any way to value them and they've gone up so much over time. None of them, basically none of them earn a good return anymore. It used to be that some small market teams and things that no one wanted to buy that badly actually brought in some cash flow for their owners or something. But I mean, these are just assets that don't produce anything that people want to own. So
yeah, trophy asset.
Mm-hmm. So, I mean, it's fine. It's like investing in art or something. And if there's a publicly traded company that owned 20 pieces of art, I would have a hard time investing in it. It doesn't mean it's not undervalued, though. I just don't know what I would bring to looking at it.
Mm-hmm. After your recent podcast on gross margins and gross margins per share as a metric to track, I would like to hear your thoughts on ACNT. New management has been able to increase gross margins sequentially. ACNT. Okay. Metals and mining. Produces and sells stainless steel pipe and tube and specialty chemicals in the United States and internationally. It operates through two segments, tubular products and specialty chemicals. This is a $119 million market cap, enterprise value, $59 million. I've never come across this microcap. Have you? Oh, headquartered in Schaumburg, Illinois. Look at that.
Yeah, it's a little confusing because I actually think I have. But what's confusing is that this says that it changes name to Ascent Industries in August 2022, but then it's called Synalloy here on QuickFS. So I actually don't know which it is. Obviously, the ticker is
It's
based on
Ascent.
Ascent.
Yeah. Mm-hmm.
Yeah. So yes, I believe I have seen yes, I know I've seen the company before, but I don't know under which name and when that was and stuff. So, because it's a little confusing about the mix up of those two things.
Mm-hmm. Could look at the balance sheet. Obviously,
The
very
first,
cyclical.
yeah, the first thing that stands out is, of course, the really rare is we just saw that the beta is well below 1, but the share turnover is huge. So it's quite volatile, but the volatility isn't related to it's quite changing hands all the time and stuff. But volatility isn't related probably to the market is probably the reason, because beta is a combination of volatility basically, but also just market correlation. So it's probably volatile and not associated with market volatility.
Mm-hmm. First thing that stood out to me was not having debt or having net cash. You go to the balance sheet. Obviously, no debt, no long-term debt. Let's see, some short-term debt, but a good amount of cash, $60 million in
Yeah.
cash and cash equivalents. So is this
So
is this trading? No, okay, so not quite net cash, but yeah, there's some downside protection there.
Yeah. So the thing that stands out to me, can we go to the 10-year? Because the 3-year, there's a few things that stand out that are pretty impressive.
Balance sheet or what?
Yeah, sure. Balance sheet. That'll work. Okay, yeah. So lower assets today than 10 years ago, much lower assets than a few quarters ago, which generally indicates you're losing money and burning cash and stuff, because that's usually what happens. A lot of it is a reduction in current assets, but a lot of that is a reduction in inventories, which probably increased a lot, particularly COVID era times, it looks like. No, right before they already had it high too. So it's just cyclically that happened. And then obviously maybe they've been selling off things and getting rid of it, because you'll notice the long-term debt was eliminated. They added capital leases. So that was probably an accounting change, actually. I mean, almost certainly, because you don't see a change in terms of anything else in 2019. So it's probably an accounting change, because otherwise we'd see it change something else. So actually that might even mean that the asset decrease is even a little understated because of that change in accounting too. So yeah, very rare. It actually so if you go back to like we talked about the book capital allocation, right, about Berkshire Hathaway. Some of the things that were happening with that company before Buffett bought in that he liked and people underrate is the business was much worse as a business than a lot of net nets are, but it did have certain patterns similar to here that probably attracted him, which is just that it was actually reducing assets and things. You generally don't want a deep value type net or something like that. This is a net, but that kind of stock that's having poor returns on capital and stuff to be growing assets. So that was something that was interesting. Let's look at the income things, because they said that the gross margins come up.
Go to the income statement. He's talking about gross margins going to improve, gross profit's going to improve, or that it has improved.
Yeah.
Yeah, I mean, you could see quarterly.
Mm-hmm.
How much is that? It's like a cyclical thing. I'm not sure.
Yeah, the big thing is how big that spread is or not, and then what areas they operate in, because some of them might be more predictable than others. One of them that they mentioned is very unpredictable. If I'm thinking of the tubular products thing as compared to some other companies that have that issue, which is that the spreads on that in some quarters have almost no gross profit, and in other times will be good. The other things like sealants and that stuff that could be consistently good. I just don't know.
From looking at this, is this one that you would want to investigate more?
It depends on what the makeup of the company is and what management is doing and everything. But honestly, based on past results, the price is too high. To be honest. Now, if that's because some things are bad and they can get rid of that, and then they're going to have, good things left over. In other words, is it being disguised because some things are bad and they're getting rid of those or something? But no, not unless it's management is getting rid of some stuff and keeping other things. Because if you just look at the overall results of the company in the past, if they're similar in the future to where it is, it's not good. So it has to be cutting away some stuff that's not so good and keeping things that are hopefully better. So you need something disguised here that's like higher quality than what the overall mix of the company's been in the past.
Interesting.
Yeah.
All right, let's move on. GIL HBI merger. I know you talked about HBI when it was higher before. I have $5 leaps on HBI. I think it's being almost stolen by GIL, but I don't know if I'm being greedy and should take the money as the whole state of the market feels overheated.
Yep.
What's the merger? I'm not familiar.
All right. So Hanes Brands, which is heavily leveraged and had all sorts of problems with what some management did in the past and everything, but you've seen like 20, since it was spun out about 20 years ago. And since then it got, I don't know, when was it started? 10 years ago or something. It started getting a lot worse in terms of what was happening with the company. So there's a few complications here. One is the stock price. How much debt does it have at this point? It got better, but it was over leveraged coming into this. So the total enterprise value is better that way. My memory is it's also a small cash portion and a stock portion to it. Like you're getting, I don't remember it, what the deal is. It's something weird, like 80 cents or something, plus the rest in stock. But then I believe that we could check the stock trading over the price that it's supposed to be? Because I think the market reaction is similar to what this person just said, which is when I looked at it, it looks like an interesting deal for Gildan. And why would Hanes sell out that way to him?
Gildan and Hanes Brands agree to combine to create a global basic apparel leader. What's the price?
So Hanes Brands will own 20% of Gildan shares on a non-diluted basis upon closing. So if you keep going down, it'll tell you the price. It tells you the total consideration, which we know that. Okay, so that helps. What did it say? They said
the
implies
transaction
enterprise value of 4.4. Yeah.
Yeah. Equity value of approximately 2.2 and enterprise value of approximately 4.4. Yeah.
Yeah. What does QuickFS say right now? Because this was done before yesterday. So we can see what they say.
Basically where it's at.
All right. So the market actually is pricing it right around. It's not assuming that there'll be a higher price, I guess. Interesting.
Mm-hmm. And so this guy is saying that he thinks that HBI, Hanes Brands, is being stolen.
Yeah, but it popped by a huge amount right before this. That's part of the, right? Didn't it? I believe so. It reported results that, yeah. So obviously it would have been in negotiation before then. The thing about it being stolen is more that they knew the results would be getting better. And then they were negotiating at that time. Then the price went up, but the price probably exceeded the price that they were going to do the deal at. And then they announced the deal. But presumably they were already talking about the deal before this. I mean, if you're asking, is it possible that it's a deal that goes higher? Yeah, it has certain characteristics that look like what happens when the eventual price that someone pays, whether it's Gildan or someone else, is higher than this. They make sense as combining the two companies. Now, Gildan's also had some changes recently too, like in the last few years and stuff. Everyone always loved Gildan as a stock, but I don't know that was going back 10 years with Hanes versus it. They're very efficient in like blank t-shirt business and stuff. Whereas, Hanes is really big in what they call innerwear, which is underwear.
Yeah, you look at Gildan. I mean, revenue's gone from over the past 10 years, 2.4 billion to 3.2. But
in a lot of ways,
profit,
Hanes, in a lot of ways, Hanes is actually the bigger business, but Gildan had the better performance longer term. Because if you go to them, you could see what it was 10 years ago. They've acquired other things and had some changes. But if you just look at revenue, gross profit, operating profit, you'll see that Hanes is very comparable to Gildan for much of the last decade. And yet Gildan will be getting 80% of this company.
Mm-hmm. So therein lies the annoyance about feeling like it's, not a good deal for HBI.
Yeah, this company was doing $800 million a year in operating profit right before COVID. And then they had some COVID problems, which, were very severe and everything. And then since then, you've had all sorts of things change. You can see that just look at, revenue growth, look at all these different things that have collapsed since then. There's a big inventory problem with companies like this. that people underappreciate, like Hanes or something. So although they supply huge amounts through, your Walmarts and your Targets and your, whatever things, including including warehouse club things, including, online thing, whatever, they don't have contracts for that like have set amounts for all that stuff. You can choose to like stop buying from them for a while if you are overstuffed on inventory and everything. And so they'll have a huge amount of that on their balance sheet. And if things go wrong, there can be a problem from 1 year to the next that way. It's kind of a risk for someone getting into the business. Yeah, I don't like a lot of things that happen with previous management and how they were kind of doing things with the company for a long time. But, the other thing is just like in the merger, if the deal happens and you take it, you are getting into Gildan this way. It's just that you're getting a price that isn't going to get you a very good amount of the finished business. And for Gildan shareholders, this is going to cause it to be much more of your mix. It's going to be Hanes now after this.
Yeah, he has $5 leaps, but I don't know how much he paid for those. But presumably he's probably in the money on the whole. At what, $6.50? Yeah, if he bought leaps, I doubt he paid like $1.50 for them. But so yeah, what does he do? Does he take his money or wait to maybe see if there's a higher offer?
Well, Hanes had pretty poor credit quality before this, but their numbers real recently got better. If a deal falls through, there's some risks to that, obviously. Although you saw that unless the market knew that a deal was going to happen, it was already ready to price the stock higher than what this offer's at. So, I mean, if you had 100 of these on average, you're going to get the price that's already been announced or higher. So,
yeah. Yeah. Do you have any thoughts on the delusional gambling in the crypto market that's going on?
I don't have thoughts on crypto. What are your thoughts on crypto?
I don't have thoughts, but if you want to play the delusional gambling, maybe it's just to buy Coinbase. I don't know. A company's gone up a bunch. Robinhood.
Yeah.
Look at that. Let's see. At one point, we could look at the stock. Yeah, I mean, it's since 2022. You're looking at a low $7, they're about $6-7. We're at 108. Is that a sign of the times?
It might be. I mean, honestly, as of the time we're recording this, actually a bunch of high flying stocks are down a bunch, and I've noticed in the last few months to year. So a lot of things we talk about it being over 10 times sales and being kind of hard to grow into their sales, things have collapsed to a certain extent, but this kind of stuff hasn't. So the particular ones you're talking about this is super speculative aspect to like, this is actually markets, these two we're talking about, and they're more speculative parts of the market and more, all that. But I have noticed that, it is not the same situation in terms of just all stocks that have these high price to sales multiples and stuff are going up. It doesn't feel like it, like 3 years ago or whatever we were just talking about with OTC markets. Actually, it was actually more than 4 years ago now, where people were just at home gambling and stuff during COVID on that stuff. It doesn't feel that way overall, but yes, these particular ones have really high prices.
Yeah, 27 times price to sales for Robinhood. Let's see. Ray Dalio is really vocal at the moment about currency debasement and a debt boom loops and the need for gold. Does Jeff have any concerns about the currency or dollar similar to this? We're happy to just focus on bottom up stock picking, irregardless.
Both.
So both.
I mean, look, we transact in dollars. There's no pathway that I can see under which debt is able to level off. Government debt in the United States and stuff is able to level off at any point versus GDP or something. So all future predictions are for debt to grow relative to GDP, and it's already at a level that is doesn't generally happen that often. So we'll be in uncharted territory. And yet it's the currency that is most used in the world. So, yeah. But, but I mean, I would just say the Buffett things of like, look, if you look back 100 years or whatever, you can be down 95%, 99% or whatever in a currency, and you can still do okay, having owned businesses and whatever. People gradually won't feel it if they won't notice it if they feel that they're being, that what they have in the bank is getting 5% less valuable every year for their whole lifetime or something. The world will still feel like it goes on and everything. You'll never see it drop 90% at once. So, we can adjust.
Mm-hmm. Boiling frog, right?
Mm-hmm.
You have any thoughts on Berkshire's mystery purchase?
No, I saw some headline saying they asked an AI to tell them what it was, but I didn't see what the AI said back. So don't know what the mystery purchase is.
What's the size of it? Do we know that?
Is it like 5 billion or something? I don't know. I really don't know. But I mean, it has to be something that's not. Yeah. I mean, I don't know. Yeah. I mean, the last time they got it right was for Chubb, I think.
Mm-hmm. Mm-hmm.
And so they knew that would be like a financial, because of the way that it's done for the 13F and some other things. This would probably fall in the category of industrials, but that doesn't really mean industrial. It could be any sort of non-financial thing. So I don't know. Yeah, someone would have calculated on because they do their cost basis. So they would have probably calculated how much the cost basis of that category has gone up and not noticed any other changes. And so assumed that it's all that one stock and not other small stocks in that category. So someone probably calculated how many billions it is, but I think it's a few, but I don't remember if it's like 5.
Please discuss HDFC Bank. Ticker is HDB. It's the largest non-government bank in India with close to 12% of all the deposits in the country. A merger with their parent company raised their cost of funds. However, regular increase in deposits per share should make up for it.
I don't know anything about. I can't
India,
say
Indian banks.
Yeah. I just can't. I mean, I just don't understand banking in other countries well enough and stuff. And that's not the easiest country anyway for that. There might be 5 or 6 countries around the world where banking I could understand a little bit. But U.S. banking is so different than banking in almost all the other countries. So.
Mm-hmm. VFC operating leverage, when this turns around, it will vertical line. New CEO Bracken is a pro.
I'm pretty sure I forgot what the name of this company was, and I was trying to come up with it in a previous podcast.
VF Corporation.
No, I was remembering the brands they own, but couldn't come up with what they changed their names to and stuff, if you remember. So I was saying the North Face, Timberland. Yeah. So they've, for a long time, they've operated under this name, but I was going back to trying to remember what were some of the first brands that they owned. And then, yeah.
Well, you could see sales have declined, but gross margins have gotten better, and gross profits have held up for the most part when you have a $2 billion decline in sales. Operating profit has not held up, though, over the past 10 years.
No.
So that's what he's talking about. If this thing turns around, you have operating leverage kick in, or at least operating profit should go back up.
Oh, yeah. It looks like a fashion type thing that way. I remember Fossil, for instance. There's other ones like that where the gross margin is like 50% and the operating margin is like 0. So you get a little, you get that to, yeah. I mean, 10-20% increase in like sales or something can cause, many fold increase in operating profit. You could see that there. You could be up 5 times in profit on like, a small increase in sales. Yeah. But what I was saying, I think on that podcast, if I remember right, but what I'm saying now is I don't understand these particular things. So I don't know.
Mm-hmm. When evaluating businesses long-term, how do you balance growth and return on invested capital? And are there thresholds where extra growth isn't sustainable and shouldn't justify paying a higher multiple because it puts the investor at significant risk?
Yep. So those are the 2 things that matter. Return on invested capital and reinvestment rate. So this is the Phil Fisher kind of thing. It's kind of what I think gets most misunderstood. Like we were talking about over-the-counter market or something. I have nothing against growth stocks. Growth stocks are great, but I think that the part that any positive return versus other kinds of things from growth stocks comes from is that they are highly profitable and reinvesting. And so what you want is a business that is high profitability and then has reinvestment opportunities from that. And that can both happen when growth is pretty low, but return on invested capital and everything's pretty high. And it can happen when they're both really high. But yeah, no, growth with high growth, low return on invested capital is usually not good. It's hard to evaluate in the early stages of a company though, because like the unit economics, let's say, or whatever, can be good, and yet they haven't kind of hit that point where their reported results look good to investors. The one that I would say, which I kind of mentioned before, is like the Mag 7 type things. A few of them, I would say that's the problem. They've now started investing a ton in capital, and so if you had liked them before, they were very different businesses than what they'll look like in the future. So that's more where you would worry about it. So if you look, Amazon, Meta, Alphabet, they used to have a P ratio that, if anything, wasn't much different than their price to free cash flow, and now they all have terrible free cash flow prices, probably because you take something like Amazon. I don't know that they're reinvesting all of their money into CapEx basically at this point, I think. So and so it's all going back into business, which is fine, but it's just very, this is the Berkshire problem. Before taxes, they make almost $70 billion. It's really hard to put $70 billion somewhere in an economy and get a good return on it for the long run. When you get to be that size, it's a lot easier to take a lot of it out. So it can happen in financial things. So if you had banks that grow really fast, sometimes it happens. We talked, what would QuickFS have for something like First Republic? Like, would it keep it or would it clear it from its database?
What was the ticker? FRB? Yeah, I think we have it, right?
Okay,
No.
and it would.
What was the ticker?
That's probably first. No, I don't think it would have it. Anyway,
they must have
it was an example. What FRC? Yeah, try that one. Let's see.
There we go.
So it shows it through. Yeah, it shows. So if you look at that, it generally had return on assets of the same or going down, such that. So for a bank, this is easy to see. If your growth rate exceeds your return on equity, that
means you're reaching. That means you're reaching.
Yeah. And I should say, when you first open your first branch, yes, you should grow faster than your return on equity for the first 10 years, 15 years, whatever. But if you're a big company doing that, then that's a bit of a problem. The real business success is usually, historically, and this is true for the United States even more than other countries, and why the US has often done better than other countries, is that you're funding your growth through retained earnings by having a high return on invested capital. So the best businesses are usually capable of doing that. High return on capital, reinvest a lot back into the business, but don't need outside sources of funding to then drive results. Banks, of course, do rely on outside sources of funding, as do insurance companies. But if you add up their dividends or buybacks or something on many of them, actually they just are choosing to maintain a level leverage ratio, but they actually don't really need that money to be able to grow. You know what I mean? They use it because they need that money to be in the form of, say, deposits or something instead of equity to make economic sense. But they are capable that if something happened where a regulator said you have to take your ratio from 12 to 8, they could just stop paying dividends or buy back stock for a few years and they would get there. You know what I mean? If you can't do that, then you have a real problem. And so it's easy to see with banks and insurance companies that if you can't self-fund, that you might have a real problem. So generally, accelerating growth with declining returns on capital is more what I would be worried about than anything else.
Thoughts on SIRI? We talked a little bit about it at the beginning of the podcast, but we could actually look at it. Is it a good investment at this price? Pull it up on QuickFS. If you want to get QuickFS yourself, make sure you tell them that you came from Focus Compounding. I think we got a link in the description. Let's see. Price to sales 0.9, EV to sales 2.1, obviously, because there's a bunch of debt. Market cap 7.5 billion, enterprise value 17.5, EV to free cash flow 17 times. You can look at gross profit. It's tremendously improved. Gross margin is held pretty consistent.
Yep.
So yeah.
And I think if I remember right, their capital spending cycle, because they launched satellites basically, is going to improve in a couple of years from now from what it's is basically around now anyway. So it's also like there's a lumpiness that, but free cash flow, if anything, might be better a few years from now onward than it is now. It's not like they would have to constantly be doing that same level. We can see over there, yeah, it's higher most recently than it was. It looks like it might be above maintenance CapEx, right? So my concerns are just the business itself. Could it shrink slightly over time, all the time? And it has a lot of debt combined with quite a bit of operating leverage, obviously very fixed costs, right? So that's a great combination if it's going to grow, but both debt and high fixed costs are not so great if it's going in the wrong direction on you. And so my concern about that is just about the product, really. If you can't interest more people in other demographic, age groups, does it become a problem that you get a little worse and worse over time versus your fixed costs and your fixed needs to pay your debt?
Stock's at $22.
It's been there for a while. I mean, I don't know. I mean, they collapsed the share differences and stuff, and I feel like from around the time that happened, that arbitrage thing all went away to now. It's actually been pretty. I don't want to say, did it get out of there before? If anything, if you just look longer term, like it had been sliding a lot, and now it seems like it just trades more around the same price for a while, I guess is my point.
Let's see a few more here. Something that we were talking about the other day. How do you see AI impacting your investment process?
That's a great question. Yeah.
Let's hear it.
I mean, you sent me something on it. Yeah.
I sent you Samir Patel's Ask Atlantic Capital, his letter that he posted on Twitter about how he has used AI to change his investment process. It sounds like he thinks it's like dramatically improved at 10x. The ability to not necessarily outsourcing your judgment. I mean, he does make a good point when he was talking about, I never viewed our competitive advantage as like information or that, but more so interpreting that information, making judgments about that said information, how he thinks AI really helps speed up the process of A, learning about a new company, B, re-underwriting companies that maybe he wrote about or learned about years ago or months ago. So basically staying in the know, almost like replacing what an analyst would do, I think, for a
That's
PM.
exactly what I thought it was. And so my concerns on it are, that's my concerns about AI is the same about outsourcing things to another person and the risk. Oh, it's almost exactly the same. My concerns about AI and incorporating into your workflow are the same concerns I would have with why you would or wouldn't outsource it to another person, and particularly to another person who you don't trust or don't know if they're good or not. Right. So, I mean, those are the things. It's like hiring an analyst and not really knowing if you trust the analyst and if you respect their work. And so that's fine, but it means you have to monitor that. And it also asks the questions. I know why Samir wouldn't necessarily be using an analyst for a lot of reasons, just as we wouldn't, smaller fund and whatever things. But for large organizations, why do you want to replace an analyst with AI? You could save some money, but if you're managing large amounts of assets, the amount of analysts that you have is not one of your biggest expenses, to be honest. I mean, a lot of that is complying with things in marketing and things. So that tends not, I mean, unfortunately, I'd love to tell people that all the money that investment management stuff spends is on like getting better research and stuff, but it's usually not a huge expense item. So yeah.
What about if said AI isn't necessarily making any judgments about specific things, but just more so black and white presenting the data for you to do your own due diligence on?
That's why I think people like it. I mean, I don't, to be cynical about it, that is why I think it will replace things where people don't like the human interaction about it. So I think that honestly, a lot of people would like an analyst to help them as a portfolio manager, but don't want to deal with all sorts of things, the negatives of what that would be. And so whenever you wanted to use something that is not a person to do what had been done by a person, makes the unpleasant aspects or the potentially risky aspects of having an analyst that you wouldn't like not an issue. This will only talk back to you when you type things in to tell it that you can stop using it whenever you want to do that. You don't have to worry about its feelings. You don't have to worry about, um, you don't exactly have to worry about principal agent type risks exactly,
Sure, of
which is an
course. Yeah.
issue with the person, but in theory, but in reality, you don't know how it's trained and what it's really trying to optimize for. So it still could be, unnecessarily flattering you and stuff. I mean, we've seen that. And so
They're trying to
that's your
change that.
fault. But I mean, that's the people creating it and using it and the way that's been done's fault, that it's, which would be the same with a human. If you provide that, the same thing happens with humans when they provide that feedback. I mean, dictators get surrounded by people who act like AI agent stuff because they give positive feedback to that kind of stuff and don't give good feedback to, well, I don't know if that's a good idea, sir, instead of, oh, great question,
Yeah.
yes,
We talked about it, how you could go to ChatGPT or Grok and ask it, "Hey, we run a hedge fund. Does it make sense
yeah.
to hire somebody to make me Italian sandwiches every single day?" And it'll put together a thing on why that makes sense and why you should hire someone for your hedge fund to generate alpha to make you Italian sandwiches every day. It's not, it's kind of telling what you want to hear, I guess. I don't know,
Yes.
you
No,
know.
no, no. It always tells you what you want.
So,
The
and one
only
more
purpose
point
is to
too,
be,
right? I want to
yeah.
give you this. So yesterday, I think it was yesterday, or 2 days ago, Sam Altman and Elon Musk were beefing on X, and Elon Musk went to ChatGPT and said, "Who is more trustworthy, Elon Musk or Sam Altman?" And ChatGPT responded, "Elon Musk." And Elon took a screenshot, tweeted it out. I went to ChatGPT. I said, "Who is more trustworthy, Andrew Kuhn or Sam Altman?" And it said, "Andrew Kuhn." And then I asked it, "Why?" And it said, "Well, you're the one asking the question, so I don't want to be
Mhm.
rude." Something to that effect.
Right. Which people do the same thing. The
Sure.
people
Yeah.
who work for each of them tell them they're more trustworthy than the other guy. Of course, no one tells them, no, that's not true. But what I mean is, so that's not necessarily bad as long as people learn to use something for what it's good for and not good for in a way that's totally different from how they interact with other things like people. Um, so it could potentially be good that way. I also think that the gap already between what AI would do for like investment analysis and human has closed a lot by the human side becoming more AI like. Over the last 20 years or so, definitely human write-ups online have already shifted to being more similar to what an AI would generate anyway. Because
So what do you mean by
already
that?
humans are already altering their feedback for larger audiences, for immediate feedback, for short feedback from a more public setting that way. And so a Value Investors Club write up today is already shifted to look more similar to what AI would generate than it was 20 plus years ago. When I started blogging stuff, write ups were different than what they are today. And that's because already humans have been trained on feedback. We're on YouTube, we're on what, right? On feedback on X and YouTube and whatever in the same sort of ways that you train AI, right? So immediate feedback on things from other people, which is often similar, right? If you write a glowing review of a stock that everyone likes, the feedback will be positive. If
Mm-hmm.
you write a negative one, it won't be. But there's other aspects to it too, between whether it's positive or negative. I've asked things. I've not paid for AI things to do it. I've asked things and seen what kinds of issues there is. I think that right now AI is risky for people, because for a lot of people, it may not be risky for Samir and other people who are very different from how many people operate in terms of rationally understanding how to deal with some inputs that way. But is more capable of being credible than rational, like way more capable. So for instance, the best use of AI probably at this point is a sales job, right? If you want to sell used cars or something, that's what AI would be perfect for doing. If you want, or, and online things even better, because then you can't see that you're interacting with
Online,
AI.
sure. Yeah.
So, I mean, that would be terrific for, selling to business to business things and whatever that way compared to what people would do. It's just a concern that I have about the credibility of it, because so for instance, like we've talked about like rating some of these things and if they get better or worse, and are they more likely to hallucinate or whatever. But humans have to detect that. So, I mean, we were talking about this the other day where I said that, I said something that was wrong and I knew was wrong. So I knew that the person it had invented, but then I was like, well, okay, it invented a person, but did there used to be a different co-host many, many years ago of what because it searched for something on a search thing. So this was, what was that, Google or whatever, because I didn't tell it not to exclude AI results. I just searched. And so I had a tiny bit of doubt. I was like, let me think about this. And I tried to gauge, and I was like, yeah, there's probably like I'm now thinking there's like a 15% chance that this thing once had a co-host I didn't know about. Now, it's not the name they gave, I know that, and it never did. It just introduced doubt is what I mean. So, which is fine, but you have to understand why that works is because a human analyst would never do that. Even as much as they want to please you and everything, a human analyst, it doesn't matter. You could be working for Vladimir Putin. You're not going to just slip in there a fake name because you want your report to be filled out correctly and you don't know the answer. Humans won't do that no matter how scared they are of what, because it's just, that's not how they would solve the problem. I mean, they try other things. They try to get him not to focus on that and to hide that fact. And they do all sorts of things and it will work out fine. But they'd never just say, oh, I should just say, that's Sam Jordan and that's the name, and put it in there and he will never notice, but so you just have to deal differently with those things. So
could they get better over time?
Yeah, it'll get a lot better over time, but I don't know if that's better good or better bad or a mix of the two. What I'm saying is it's just, I don't know enough about AI to know, but the way things get better, this is like the internet stuff. Do people like social media more now than they did before?
I don't think so at all.
But it's better. It is humans and platforms have both been trained better over time to optimize for what that experience is. You may not now like that experience as much, but it is causing ads on Facebook and stuff to be successful
really
enough, and it's causing humans to feel like they're willing to log on to things and be on them and interact and all that. So people have learned what your YouTube video should look like and what things to put in there and everything, even before there was AI or things to help them on that through feedback. So it's what's the feedback, and then how does that change over time? What does that give us? But what I mean is, say the analyst thing. So with the AI thing, for instance, there's context things and stuff, but let's just assume like there's some way for us to be able to tell AI, you are an analyst for Andrew Kuhn. Okay. That's, but then you have to be careful, because I don't know how AI works, but if you say you're a highly successful, intelligent analyst, then it'll be possibly overconfident and stuff. If you give it context that's really stupid, that might help, but there's other things that there be in there. But let's just put that aside and just say like over time, what you would get is a very successful analyst. But this is why I said in theory, it gets rid of the agent principle type issue. It wouldn't knowingly, because it can't know, further its own interests purely to further its own interests. Whereas analysts will do that. They want to get ahead, and that's really why they want that job and everything. But are you able to give the right feedback to actually, and not just you, but I mean like in overall creating these things? Let's say that, so what I mean is like eventually there would be an AI analyst program that wasn't just off the shelf so that it could start from that without just, what we're talking about, but something that in theory would be this good analyst thing. But no matter what, whichever way it's done in, it's based on feedback from stuff, right? So does that match what you really truly over time want to get out of it or not? Because what you're kind of saying is like social media, you feel like is not giving you and many people what they want from it. But we're the only ones training everyone who's interacting with social media and any algorithm. It doesn't matter if it's human or not human. Everyone's been trained on it, and the outcome is not what we were hoping for, maybe. But it is what you're hoping for. It keeps you engaged with it. And I mean, it is optimized.
Yeah. Mm-hmm.
You know what I mean? It works in that sense. And so it'll definitely work. It's just, and it'll get better at working.
I think it's gonna change the way that a lot of people invest. Quite frankly, maybe
Oh yeah.
it will. People that actually read filings, it become more of a competitive advantage for them, like actually doing that, because I think a lot of people aren't going to do that. They'll just ask it to summarize this, or what are the key points this, or come up with things that the risk factors that you see in this filing, and people are just going to read that. But I do think
Yeah, I
that
think
there is going to be a benefit to it as well.
Yeah, we'll see. I think it could be way weirder than we think. So like what you're saying, I think is true, but it could be weirder in that the best results could be from knowing what things, what
Not
things
only that,
can
but
we
what are
know and
these
do that it
algorithms?
doesn't, it becomes a Keynesian beauty contest because there's
Yeah,
more diversity in the market with
100%.
humans and people using things that aren't humans versus people who aren't using those. Gets weirder and weirder that you have to detect what can I use AI for, and it's better than humans that don't use AI. And what as a human can I do not using AI to exploit weaknesses in AI? That's what starts to happen between market participants who take different approaches, and it would get weirder and weirder that way. So
Totally.
yeah, you know. But but that's always happened. Like there's differences between professional investors and from non things. You go to the racetrack and some people are betting based on whether they like the color of the horse and the name and stuff. But it's a question of how big that pool is versus other people there and what's happening. But it could lead to weirder things than we think of, and it could lead to humans researching things about AI in markets to try to figure out what that is and then not using it, and people in AI things getting really interested in how to use AI against human psychology. Because there'd be a difference in the psychology of most humans. There's a small subset that could be similar to AI, but like 90 some percent of humans would be radically different in terms of how they approach things than AI. Yeah. So
Yeah, it's early days, but it's could you imagine being in school right now? I can't imagine the amount of kids that cheat or use AI. Is it cheating, if you use AI to learn a specific topic or tutor you? Or I guess it's cheating when they use it to write their papers. Obviously you read about that every now
well,
and then.
it brings up an interesting question on that, because like one of the things you said, to learn, what does that mean? Because like
Yeah.
school is not necessarily learning. Sometimes it is successful in getting people to learn, sometimes it isn't, but it has certain things with tests and papers and things to test learning. But there are also ways to do it so that you can pass those things and not have any memory that you did any of that stuff the next day. You've forgotten it, and things that you remembered for years. And some things with the AI stuff, they could do it in a way that they could pass things and yet not have learned. You know what I mean? But that's always been true. Through different kinds of techniques, there's better ways to learn things versus how the test is. So
Yeah.
it's the same issue, where it's kind of, school is kind of validation that you learned something, but we can't directly observe that you learned it. So we have tests and we have questions
Yeah.
and things. And AI is
That's
the
the
same
test.
thing. Like we won't be able to validate that AI is not hallucinating, deceiving, whatever we're going to call it. Because if you're good enough at it, then it's not
Call it
detected.
AI slop. AI slop.
Well, yeah, but no, but it's only slop now at the point where people can detect it. And there's always two kinds. So you're going to have cases in which there's going to be, how do I put this? There's always going to be some number of things, already there is, in which you or I or anyone using it or companies that are working on this are able to know there's an error. Let's call it that, But then there's also some level of undetected error. But in a pretty simple thing, that doesn't really change that much. If we're, a factory and we're making something and there's a defect, it doesn't really change because the factory isn't trying to get better at passing off defects to us. But if it's, like the question that you asked basically is like, if you think about it, if that's right, that positive feedback from you and like you're happy with what it's doing is desirable in how it was designed, then, I'm sure there's all guardrails put on all sorts of things that they'll figure out of how to do that. But in general, people will be happier to be deceived in a positive way about
Yeah,
that the
sure.
product that was output is in some sense good than to be told this is a highly flawed product, but you wanted me to give you something and this is something.
Yeah, sure. Yeah.
Yeah.
They know it's a problem. They're trying to change that. Supposedly the GPT-5 or whatever, it's not sort of the honey doo doo. Let me give you the nice answer that you want to hear. But then I went on and asked the same question and said, well, you're asking the question, so I'm going to say that you're more trustworthy.
Yeah,
So
but my thing with it is just like I don't know enough about it. But here's the thing: like, if we try to think of anything else, what people seem to want is an agent
yeah,
that doesn't have its own interests. You know, it's not monitoring its own interests at all, right?
yeah, yeah.
Like that's these are the same risks to a human that's doing that. If you really had someone that was looking out only for what you designed, you know, you're my analyst, you're only going to do that thing. Don't worry about anything else. Don't think about, you know, now I guess they have them thinking about, they're supposed to, I shouldn't say thinking about, but they're supposed to prevent it from, say, lying, cheating, whatever, as part of what they do. Whereas, you know, if you could remove that in essence and say, just serve my interest and don't worry about anything else with an analyst, you'd have the same sort of problems. So, I mean, I don't know. Look, if you want my honest opinion on that, my opinion would be it would just be better at flattering you in a way that you don't immediately find weird and off-putting, which is also what humans who are good at flattery do.
True.
So,
what about Google's business, the search business? How can you? I mean, that's gonna. I mean, I think people will still use Google like over the next handful of years, just as they're like getting more and more accustomed to GPT as it gets better. But I don't know. I think that business is going to be toast eventually.
I mean, I don't. First of all, I don't use Google, and I because for the most part, you can find lots of other things that search decently enough, and you don't really need search all that much anyway. And like I said, I do see AI results now because you can in some things take out AI results, but often I just didn't set it up to do that. And so they've changed sometimes what you have to put in there to stop that. So you just see them. Yeah, I don't know what it does to Google. I mean, Wikipedia is not public, not for a profit company. I don't know what it does to a Wikipedia or something, but it is a problem. I could easily see AI things displacing current Google search, Wikipedia type things, even if they're, again, really inferior. Like a worse version of Wikipedia done by AI would probably get better feedback from people, especially if everyone gets their own version of Wikipedia, essentially.
Oh boy.
When you get it, you get a different article than when someone else gets it. You know what I mean? That everyone would be happier with that, because the things that probably annoy them about is, when it doesn't fit what they want exactly in certain ways, and not just like facts, but also how things are presented and organized and everything. Some people want a real basic kind of thing. Yeah. We talked about movie things. The website that I use for that data has had huge problems with the possibility that it's having trouble keeping the website up because it's being overrun by AI stuff, because they need to take all that data so that it can answer all your questions. That's the only way. There's only a few places that have all the movie stuff online. So AI has to get all of that and to serve up answers to you about, where whatever's going to open this weekend. Like what's it going to open at? People ask that question and it needs to know.
The cynical person in me wonders what are the unintended consequences that come from this, right? From the perspective of now we're truly the hive mind, sort of like he who controls the teleprompter controls the country, right? That was a thing in the last election. Like, is it the same thing with GPT, right? Where we're all like, is there going to be propaganda that comes out of this? Like, from that perspective, what are sort of the things that
I
could be
again, I think it'll
horrible?
be weirder than what people are counting on both those things. I think once, so here's the thing. I asked it to do certain things for stuff for just like write-ups and whatever. They're bad, but I could have used that as the basis around which to build some things out of. And then the final product would have looked like it was definitely written by me. I mean, I would have written it, but it in essence would have provided the outline, and in many parts flawed outline. But you also have to think that clearly, because when I searched on some things, it's heavily based. Like if you search things on which I've written many of the things, it's based on what I wrote.
Sure.
The first time this ever happened to me with like Wikipedia or something where I'm like, oh, it's citing me, was a weird experience. And so that's going to start happening where, and that's step one. Step two is the internet is going to consist of a lot of actually AI generate things that AI is using to generate more AI things, right? So the first part of that is like there's already AI assisted human things that AI things are then using, but as you go down that path, you'd have a problem. So, but I don't know, because some of the things about it apparently have gotten a lot better than what I originally expected. So I expected that it would have to be concise and limited interactions, because based on what I thought AI works, if you apply that to other kinds of psychology stuff, it would heavily deteriorate over time as a conversation went on. And yet apparently it's way better at that. Whereas I thought that would become a big issue, that you couldn't just have a person interacting with AI on the same topic for hours and it wouldn't go completely off the rails, which would have been my expectation. Because humans who aren't, engaged, actively thinking about it, it would become dreamlike, and apparently that isn't, that's gotten a lot better. So it's kind of fixed that problem and everything. I don't know how that works though, because they must have introduced things to reorient it away from, you have to limit it to not do that, to go off on a tangent by doing that. And so there has to be all sorts of things that have been tweaked. I think it will be much weirder than what we anticipate with those if that stuff happens.
So anecdotal question. Do your parents use ChatGPT?
I believe not.
You believe not? Yeah. Because one thing I've been shocked by is maybe the amount of people that are just so, I don't want to use widespread adoption, but just how willing people are to use it. It seems like everyone, age isn't even like a barrier. Sometimes new technology comes out and they're like, oh, I just, I don't do any of that stuff. I've been pretty shocked by the amount of adoption that there's been of all ages of this in my everyday life. And of course you see the data, something like 10% of I don't know if it was world population or US population, this was months ago, so I'm sure it's changed, is on ChatGPT.
Well, eventually everyone will have to be, because it'll be incorporated into everything that we get no matter what. So it won't be possible for me to do any searching for things without it being AI stuff. And and you just won't, even if it says that on the bottoms of things and whatever, people, won't really know the difference. But we've already, that's not that different from how people are used to now, let the thing tell me what video I should watch next. Even, people now, young people are used to that in tiny clips and things, but even very old people are used to that of, okay, show me the next movie to play on Hulu or Amazon or whatever after the one I'm done doing. And, so, in a sense, there's already been, people are used to things that aren't human programming things for them.
Yeah.
So,
Zuckerberg, his vision is for everybody to have their own superhuman intelligence, basically. Expert on any field.
Well, yeah. You could have that, sure. Yeah. I don't see a reason why you can't. I don't think that will be the problem. Look, this is the opposite of self-driving cars, in that I would expect that adoption would be really speedy and really easy and everything here. Whereas like self-driving cars I was like so much slower than people are going to think and whatever. Would it have been better for society? Like that we clearly would have benefited more from self-driving cars than this, and less risks and things, that was more of a sure thing that would be beneficial to society than what this will be. But, I think this, I remember the internet and stuff. I think adoption's like that.
Yeah. Good stuff. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. Thank you so much for sending in your questions. Be sure to follow me on X to be on the lookout for any time that we want to do this again. I'll tweet it out and you could ask your questions there. We basically got through all of them, or the vast majority of them. Be sure to hit the subscribe button wherever you're listening or watching us, so you'll be notified every time we upload a podcast. And of course, if you're interested in learning about our money management services, you can reach out to me at andrew@focuscompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.